The Hedgeless Horseman here again. September 15th. This is the second video of today. I just wanted to do a short follow-up to the last rant. In that rant, I discussed the fact that my theory is that some hot sectors, etc. It's more about greater full trading than actual good risk reward and value investing. And I named uranium as a candidate, which I think, given the hype and all of that, my theory was that unlike gold and silver miners, where they're actually very cheap relative to the current price of gold and silver, especially gold. In uranium, my hunch was that there is potentially a high premium for a future that is not yet here, basically a bullish, a premium on a bullish future that has not yet arrived. So you're kind of overpaying for the now, speculating on an even brighter future. I wasn't sure. It was like I know this company that a friend of mine is very bullish on in uranium. He's I would describe him as kinda emotional, even though he would not admit that. And so he's extremely bullish on this uranium company called Encore Energy Corp. And I just looked at it, like 1.4 billion in market cap, obviously. Great run, 2 years, in the last 2 years, 1,000% return. And so I finally just looked at the presentation, and I don't know this company well at all, really. I don't know the uranium business well at all either, but it's just a few things stand out. Take this Dewey Burdock, South Dakota project. It says robust project economics. It's a PEA. PEAs typically are a bit optimistic. And you can see here the post-tax NPV with 8%. That's US 147 million. And that's, it says economics at a uranium price of $55 per pound. I think the current price is 51. So here you have a PEA where the stated NPV is they're using a higher, the used price level for uranium is actually higher than the current price of uranium. But okay, that's US 150. Then they have Gas Hills project that also has a preliminary economic study done on it, which again typically tend to be a bit over optimistic. It's also using a higher price of uranium than today, and that's NPV, post-tax NPV comes out at 100 and almost 103 million US. So that's a combined net present value of 250 million US at a uranium price that is slightly higher than where it is today. Then they have some other projects, and to be fair, again, it's like I don't really know how much value these assets have. It says total estimated resource, and blah, blah. So that, I mean, this might be valuable as well, obviously. Then they have another, I guess, kind of small project, and then they have some other assets, etc. And I think Texas near-term production. I'm assuming this might be another project than the other ones, but I'm not really sure. Rosita Central Processing Plant. I don't know if this is tied into the other ones, but anyway. Okay, so the two advanced projects with an actual PEA at least, they have a combined net present value of US 250 million at a slightly higher price than uranium is trading at today. The market cap is 1.4 billion Canadian. So let's say that's around, I don't know, 300 million Canadian in NPV. I think it's slightly over that, but that's like 1.1 billion Canadian is priced in on top of the net present value of these two, actually advanced projects. That kinda leads me to believe that this is certainly, this does not look like a value play, because in that case, if we even say it's 400 million for the two projects, that's 1 billion, more than twice what the two PEAs suggest the two of the projects are worth combined. That just feels like, again, without knowing the company too much or what the other earlier stage assets are worth, it feels like a stretch to put up value of 1 billion on the other assets, given the value put on these advanced assets, and PEA on top of that, not a PFS or a feasibility study. So it's like, when I see this, I'm like, heck no. I mean, I don't feel like I would be buying low or, cheap at all. That does not say that uranium doesn't go from 51 or whatever it's trading at right now to like 150, and this will look cheap in the future. But it obviously looks like this particular stock is pricing in a much higher uranium price already. So if that's wrong, you can imagine what could happen with the market cap. Because let's say if uranium trades down to 35 pounds per dollar per pound, it just says that, okay, low uranium prices IR of 17 and this is IR of 50. So I don't know, maybe the combined net present value of these two deposits would go down to, I don't know, 100 million US combined. So 100 million in that case, and that would leave like, let's say 100 million Canadian actually. That would leave 1.3 billion in market cap to cover the earlier stage projects. And if the advanced stage projects are worth 100 million, I don't think that the earlier stage asset would be worth 1.3 billion. That just feels like it leaves a lot of room to the downside. Again, I'm not talking about guarantees or anything like that, but risk reward. This feels like, I guess it's not just for Encore Energy, feels like you're actually paying up today for a brighter future that is not happened yet. So that's obviously the polar opposite of a value play. So but with that said, like my point in the last video, that if you have these absolutely slaughters in some commodity spaces, I mean, look at this. This is an Encore. I guess there was a commodity bull in uranium as well, like gold, silver, and all of other types of metals. So this stock went down 99%. I mean, that was pretty much all wiped out. If you had $100 invested, you would have $1 left. Still, that sector also bottomed, and this stock also bottomed and went up 22,000% from bottom to top here. And when you think about it, it's like from this level here, which is around $2.7 per share, to a top of 6.8, that's 150% return. Around here. When you think about it, it's like 150%, that's kind of okay over 10 years actually, even though I know it doesn't sound like that at all and nobody would actually go investing for that. Still, if you bought this company here and just held it after being down, it was actually more, more than, okay. But if you bought this stock here, followed it down 99%, then it went up like 22,000 to this top, you would have made an acceptable compounded annual growth rate from buying here being down 99%. So when you think about just buying and hodling this, and you would have still had an okay return over this period from 2012 to 2021-22. Obviously, if you made one buy lower, that would be an even better return. I'm just trying to show that's like we see all the time. Like today, right now, gold and silver is falling, and everybody's running around with the hair on fire. So let's say juniors are let's say I don't think the gold silver space is going to go down 99% from the top, but let's say we are here no, let's say we are here, and there might be a flush. Okay, that's actually too extreme. I mean, 85%. Bad example. Let's say we're down here already. You know, we are close to bear market bottom levels. Let's say that they could go down 44% more from now, and people who haven't sold now and just ride along for that, everybody's going to feel like they made a terrible mistake. Like the guy who bought here and saw his investment go down 99%. He felt like a total idiot all the way down, and looked like a total idiot, especially here. But already here, when that was probably minus 80% already. Anyway, when the turn actually happens, I mean, to the next sentiment top, that's a big return. Obviously, it would still be worth it. That's what 12,000%, not 1,200, 12,000%. You could put in $100 anywhere here, and that would amount to a large amount of money. What I'm trying to show is, again, timing a cyclical. When cyclical sectors become extremely cheap, timing is not really a big thing. You could bought here, you could have bought here. Anyway, when the final turn comes, and short will take years, and that's actually the hardest part, it doesn't really matter. And that's why, the Fidelity study would show that dead investors outperform living investors, because they just hodl through everything. And just to another example of like what's actually going on in the gold space, this is TriStar Gold, market cap 33. Here you have their PFS study, which is a more advanced study than a PEA. After tax MPV at 1,550 base case gold price scenario, 321 million US. So that's like 400. So it's selling for less than 1/10 of the net present value. And this net present value is using a $1,500 gold price. Not in the case of Encore, they used a higher, the NPV is based on a higher uranium price than where uranium is actually trading. This is trading at 1/5 of the net present value, which would be in place at a lower gold price. So compare those margins of safety. In the gold sector, you might be looking at up to a 90% discount to net present value. In uranium juniors, my guess is they're actually trading at a big premium to the current price of uranium. That's an exponential difference in risk reward. Montage Gold unfortunately does not have, I was going to look at their presentation, they have a market cap of like 61. I think their latest net present value is like 500 million or something, again around 1/10. Nucor trading, these two last ones are actually in Africa, so they are going to be cheaper than the Canadian juniors, but it's like, okay, 32 million Canadian, after tax MPV, not a lot, but still lower price used here than the current price of gold. US 220, so that's, I don't know, 250 million, or let's say 1/9 of the NPV that's selling for. We have Skina 522, that's in a premier jurisdiction. It's in British Columbia, Canada, one of the absolutely hottest areas. 522 523 million Canadian market cap. They just come out with a feasibility study actually. So as up to date as you can get, released today. Base case 1700. Okay, now it's a bit lower than that actually. After tax net present value 1.4 billion. If we use $1,600 gold, 1.2 billion. If we go down to 1500, that's after tax of 1.0 billion. Still an after tax IRR of 41%. Compare that to, the uranium. Here, if we go lower in uranium, then the IRR is down to 17%. In the case of Skina, even if gold dropped to 1500, it would have an after-tax IRR of 41%, and the after-tax net present value would still be twice as high as the current market cap. In Encore, based on their advanced assets, this is trading for multiples about more than the net present value. Skina, a gold silver junior, is trading at half the value of the net present value of the project at a lower gold and silver price. So if we would translate like what the apparent premium is in Encore, which is a uranium junior, for example, of course they're more advanced, I think, but still that would be like have Skina Resources trade for multiples of 1.4 billion. Maybe let's say let's have this one 17. That's like if Skina was trading at 4 or 5 billion today. That is what it appears is going on in terms of relative valuations between a hot sector, uranium, and a cheap sector, gold. So you can just see here, for example, in Encore, here you have absolutely slaughtered uranium sector, I'm assuming. So that's trading for, and we can see that efficient uranium, that got absolutely slaughtered. So it went from being absolutely extremely undervalued, which we're seeing in the gold juniors already, and silver juniors, to trading at a premium, I would guess. And that's why you have this huge swing. So you go from a sentiment extreme low to a sentiment extreme high, and you have 12 to 23,000% price change. It's just unreal what happens if you're able to buy these slaughtered sectors and hold them long enough that the sector does not only become fairly priced, which might be, who knows, here or something, but actually overpriced given the current environment. So I would personally not touch, if I'm somewhat correct in my simple analysis here of this uranium junior, which I think goes for most uranium juniors, I would not touch uranium right now. Especially not sell a sector that is trading at a premium to the current levels, while I showed last time, Bear Creek Mining down, close to around 80%. Just trying to make a point here about the idea is to buy extreme lows. The cheaper they get, the better, because it just hikes up the future returns. So again, while juniors in gold and silver, this one, for example, high delta beta, this is down 86%. It's not down as much as some of these uranium miners were when they bought them, but it still wouldn't matter. If you bought here, that's 300%. You can see, regardless, if you didn't snag this bottom, it doesn't really matter. Any return from, if you start buying at this level, that would be more than worth it. That's like 160% in 2-3 years. Great returns. The more you bought, the lower it went, the more money you made. That's how simple it is. So now, if it's trading, this kind of looks like a bull flag in fission uranium. So again, uranium might spike and it might go higher, but from a risk-reward perspective, it makes absolutely no sense, in my opinion, risk reward is not a guarantee that you will win or lose. It's just that how much will you gain if this goes higher. Yes, if this breaks out, maybe this bull flag is signaling like a 60 cents rise in price. So yeah, you get a 70% return in this one. But I mean, the juniors, gold and silver, when they turn, I mean, we're not talking 60% from bottom to top, especially from a extreme sentiment low to like a, what the hell? If you know what I mean. Yes, to the next, let's say an acceptable sentiment high, that's 544. If we go into a, let's say uranium is trading up here already. So it's like I expect much higher returns in gold and silver juniors. I just thought it was a very interesting example when I actually looked into it. It's like, okay, this looks incredibly overvalued. And at the same time, you have like today, they're getting everything is getting sold today, and gold, silver down, quite a bit, not a massacre, but still. But I mean, we know how this ends anyway. I mean, the quicker everything turns to shit, the quicker they have to. Fed has got to do something, or someone is going to do something, or the system collapses and then gold wins anyway, or we might, print endless amount of money and gold probably wins anyway. In that case, I mean, gold is the only thing that's worked for like 5,000 years. So regardless, your gold is not going to go away. So I just see this as an acceleration towards the end game, which is when they have to revamp the monetary system, etc., and the debt bubble, and that's when real assets will shine. So it's just again, we're just getting there quicker, and like we saw in 2008, 2009, and the flash crash. Yes, gold and silver goes down. And miners as well during the flush. It's what comes after the flush, and the same goes for any commodity. I showed potash and lithium. It's what comes after the flushes that the big money is made. So I mean that's it. It's like, do you need to market time this? I don't think so. It's like, who cares? Who cares? Down 30% more. Who cares? It's just gonna go way up even more. Same thing here. Who cares if you started buying here? As long as you bought all the way down, you could come out as a bandit. If you went full position here, 274% returns, even though it went down 75% first. The costliest thing you can do is sell low. The most profitable thing you can do is buy low. That's how it is. Not investing advice. Consider me biased, yada yada yada. Thanks for listening. Bye.